Hello there, I'm Monica Gibson. I'm joined in the studio by Eric Vanraes. He is Head of Fixed Income at EI Sturdza. Eric, welcome back. Pleasure to have you here.
Thank you.
Now we're going to put some interesting things to speak about today. First things first, we have to talk really about the bond markets. So much activity, so much unusual activity really. What do you make of it, and what do you think investors will do next, so to speak?
Yes, there was a lot of activity, but first and foremost, there was a lot of volatility. The Bund experienced a dramatic sell-off. It is not so dramatic, but from 0.07 to 0.70, it was unusual because after 3-4 years of QE, investors forgot that volatility is in the market, and volatility is back. So it was a surprise, and the activity was more important than before. The activity was very important on the derivative market, because if you have a look at the flows on the cash bonds, there was not a lot of activity finally, because, for example, in my fund, I didn't trade a lot in between end of March and beginning of May.
That's very interesting points. Now, looking at the Eurozone a little bit closer, there have been some glimmers of hope, you could say. But at the same time, do you think it's enough? Do you foresee any change in the ECB's policy path at present? Not
at all. I think that the ECB, they have a program and they will follow the program. I cannot imagine the ECB starting tapering like the Fed last year. I cannot imagine it. Mr. Draghi said that they will buy 60 billion per month until September, October 2016. They will do it. And the risk, if there is a risk, is that they can double or triple this amount in order to maintain the markets at a good level if there is an accident with Greece or something like that. But Mr. Draghi will follow his route and will not change. The good news from Europe, first, they are not so good, because when you are very low, a small rebound is still a small rebound, but it's in the market we say sometimes it's a dead cat bounce. And it's also normal, because you have what the French called at the beginning of the year the alignment of the 4 magic planets. Low euro, low oil price, low interest rates, and the ECB QE, quantitative easing. So if things do not improve with these 4 boosters, it's a nightmare, you know. So it's normal that the European economy start to improve a little bit, but things are, it's not a solid recovery. We have to be very patient and keep in mind that, for example, unemployment rates are very ugly. In Spain, it's above 24%. In Italy, it's almost 14%. In France, they reached more than 3.5 million jobless numbers. So it is still worrying. The European situation is still worrying. It's improving, obviously, with these 4 boosters, but it's not a solid recovery, and this recovery is not sufficient to lead to a new policy of the ECB.
Indeed. I mean, talking about an unsteady or an uneven recovery, again, we can bring into the US side of things. Every sort of good piece of data that we have is followed by one which comes as quite disappointing. You mentioned unemployment in Europe. That's quite good in the US, but then we have wages, which is seemingly reluctant to rise, and it's really putting off that perhaps Fed rate hike that everyone seems to be kind of waiting for, but nervous about as well. Overall, would you say, are you bullish or bearish on the US?
I'm bullish. So it's a bit contrarian, but I'm bullish on US yields because I think it's too early because international flows are not in favor of US yields because the consensus is still persuaded that the US economy is in good shape and is improving, and the consensus is persuaded that the Federal Reserve will start to normalize its monetary policy. It's true, but it depends on the pace of the normalization. And everybody learned at school that when an economy is improving and the central bank is starting to raise rates, it's not time at all to buy the bonds. But I'm sure that in the coming weeks, in the coming months, investors will change, and we will see that the US economy is not so bright. The figures, you have hidden figures behind the official figures. And obviously, if the real unemployment rate was below 5.5 as published, and if growth was above 2.5–3%, I cannot imagine that the Fed doesn't do anything. The Fed should have reacted before and not only once. This is the proof that the figures are not so bright, and the picture in the US is mixed. The problem is that I already said this last year, but last year I was saying that the big difference was coming from the microeconomic environment, because earnings of US corporates were great. So the US situation is not good, but the consensus is not yet prepared to say that. Once they are prepared to say that, they will see that the US 10-year yields are above 2%. It is above Spain, above Italy, which are BBB rated. It's between Italy, Spain, and Portugal, Portugal is still junk, and it's just above US, and Germany is at 0.40. So, in my opinion, it will become a no-brainer to switch from European government bonds to US treasuries. But it's too early because the consensus is still bullish on the US economy, and is still afraid of the hawkish tone of the Fed.
Well, that is the whole thing about numbers. There's always a different way to interpret them. But thank you so much, Eric, for coming in today and sharing your insights with us. It's been a pleasure.
Thank you very much.
Thank you. Okay, well, that's all from Eric and myself for the moment, but please do keep on clicking back to Dukascopy TV. Goodbye for now.